Welcome back to another lesson. So this lesson today is, quite a basic one. It's quite an easy one in the sense of if X happens or if X doesn't happen, then we don't trade, specific sessions. With this lesson, I want to focus on intraday trading only. I'm not talking about high time frame. I will touch on it a tiny bit at the end, but it is mainly about how we trade certain sessions and when we know not to trade, certain sessions. So let's get into it. Right. The first one is very easy, right? The Asia range. The Asia range sets up framework for us, right? If we know there's a consolidation, it's very easy to know what to expect next, typically. Of course, not always, but most of the time. Aside from, the specifics, London might go into this array, blah, blah. What do we expect? We expect some sort of manipulation. We expect London to take one side. Sometimes it takes both sides, but we expect it to take one side at least. And then NY can expand to the other side. This formed that, that typical AMD pattern, accumulation, manipulation, distribution, power of three. That happens if Asia is a range, right? Because why? Consolidation is engineer liquidity on both sides. That allows, London to come and manipulate into one side and then, of course, expand to the other. When Asia is not a range, when Asia trends, it moves, it gives you a large move, and you guys can see, very clearly there's not liquidity engineered on both sides. We usually end up with something called London slop. Now, the London slop is when price action during London will be very slow to account for the fact that Asia actually delivered, right? When this happens, of course, when Asia has delivered and now maybe perhaps you've woken up and you're seeing that London's not really offering a move, it's moving sideways, it's probably best to just click off and come back for New York kill zone, because that is what you will usually get. After we get, a very large delivery, we usually go into some sort of accumulation or consolidation and vice versa. Now, another thing that's actually not on the PowerPoint, and I'd like you guys to, make a note of, please. If we have a large range day, right, on the following day, we tend not to trade London. London will usually be dry. For example, let's say your expected ADR was about 90 pips and today delivers 150 pips. Then tomorrow is very likely that the London session will be very dry. Now, when I say these things, these are general expectations. Of course, there will be exceptions. Sometimes you won't trade and you'll think, I wish I traded. London was nice. Of course, that will happen. But most of the time, it's likely that, the London session on the following day, London Open Kilden specifically, will be dry. Now, the third point, right? The Asia to London OTE. Of course, we typically expect the London slop when Asia trends, but it is possible, depending what Asia traded into, that we can get an Asia to London OTE. This is similar to the London to New York kill zone OTE. We get that retracement between the sessions. It's possible that we also get that between Asia and London. Now, this isn't seen as often as the London to New York one, but of course it can still happen. Price trades up, heads into some sort of area of imbalance and array, and then rejects. Now, for this to happen, it's pretty simple in my eyes. You draw out your range, you mark out your high time frame arrays, and you know that this day is going to have quite an obvious expansion in one direction. That's what you're expecting. Your drawn liquidity is obvious, and that's when it may be offered, right? Especially, I don't know, let's say in context, um, yesterday was Tuesday, it's putting the high of the week. You've now come on, it's Wednesday, and you know that Tuesday traded into, I don't know, a daily order block and price rejected away. And now Asia has also moved lower. That's, it's possible that you see some sort of retracement into Asia and then see a continuation during London, right? First the retracement, and of course the expansion to the sell side. Now the last point, very simple. If the CBDR is over 50 pips, do not use it. Now let's think about this one logically, guys. If, right, your ADR most days on EU, very recently it's been, horrible, but most days we're expecting, I don't know, let's say 80, 90, 100, around that area, right? If, when we draw a CBDR, we project it both sides. We project 50 pips up, 50 pips below, and, depending on your bias, you consider the arrays. Now, if, London comes and you've projected your CBDR and it's over 50 pips, it's, I don't know, for me personally, even above 40 pips at times can be a bit weird, but 50 pips specifically below and above, right? If your ADR is not going to be very high, It's going to be a small range day. Is it likely that you can use the deviations of the CBDR? It's very unlikely it's going to reach somewhere. I'll still consider one CBDR. If I have a 50 pip CBDR, I'll consider one standard deviation and maybe mark out the 0.5. If you guys recall the CBDR lesson, I said mark out the 0.5. So if you have 1, 1.5, 2, 2.5, and so forth, and see what lines up, right? So with this, it's really about logic. If tomorrow's expected CBDR is the expected ADR, tomorrow is 80 pips, and now your CBDR has delivered 50 pips. Does it make sense to measure the protraction using that? Probably not, right? You want to make sure that it lines up. So, good study. Today is the 25th January, Wednesday, right? The CBDR yesterday was 17 pips. I actually used the CBDR. I've sent this into the chat. You guys can go on the charts and line this up yourself and see what happened. This is on Euro USD. The CBDR actually ended up being, if I remember correctly, about 17 pips, right? And if you remember the lesson, I said ideally we want to see 30 pips. But what's happened is most days on Euro USD recently have been very small range days. My expected ADR today was 66 pips. So does a 17 pip CBDR make sense? Yes, it does. If I'm expecting a smaller range day, then it makes sense to get a smaller range CBDR. And that is what happened today. And they lined up pretty well. So you guys can go look at that example for yourself or find it in the chat. Now, the ADR. One of my favorite, personal favorite concepts. Now, a lot of these things are about logic. And we want to think about, where is price delivery and how far it's going to go. We have an expected daily range every day. You're expecting 70, 80 pips, whatever. Now, if London has come and delivered, right? Let's say your expected ADR is, let's say 80 pips, yeah? And London has come and now from the high of London to the bottom it's delivered about 65 pips. Is it favorable to short in NY? Right, just take a second, think about that. You're expecting about 15 more pips of movement, right? Is it favorable? Probably not. If you miss that, move in London, it's fine. Some days you just gotta give it a rest and it's fine. Go again the next day. It happens. But don't force it. Because just because you see a target does not mean price will reach it. Just because you see an obvious drawn liquidity or liquidity pool, price may not reach that. Price, may not move as much as you want it to. If your ADR is 80 and the price you're targeting, the price level is another 40 pips away and you've already delivered about 65, is it likely price will reach there? No. Is it possible? Yes, but is it likely? Probably not. Right? We have to think in probabilities. So that's a very simple one. Session to session, you see how much of the daily range that you expected has been delivered. If London now comes and only delivers about from the high of London, let's say it's a bearish day from the high of London right to the low, you've delivered so far about 40 pips, and you're expecting further bearish expansion. So now you have another 40 pips to deliver during your kill zone. This definitely allows you to get in a good chance, right? Because it will offer a retracement, and then from that retracement, it could be 50, 60 pips lower that your target is. And that 50, 60 pip area, that's all an area for you to get in line with price and, scalp out 1 hour, 2 hour, whatever you're targeting, right? So always consider the ADR. That's, of course, like I said, one of my favorite concepts because it's all based around logic. Now, PD arrays. Of course, the last lesson was the PD array matrix and where we are in the range and how the arrays form. If, right, London has delivered, let's say 60 pips, right, and now trades into a PD array, you expect NY, New York Kill Zone, to expand away from that PD array. Of course, given that a market structure shift happens, you've had a nice reaction, blah, blah, blah. All the context aside for a second, let's just say London trades into PD array, you get a reaction. Now you expect New York Kill Zone to trade away, right? With that, of course, you want to trade New York Kill Zone because now you've entered, a program, let's say for the algorithm, a buy or sell program has been initiated. When this happens, you expect price to deliver. And what can we target? We can target opposing arrays or we can target liquidity, right? makes a lot more sense to target liquidity in my eyes, so let's just stick with that. Price reacts to an array, moves the way you target liquidity. This makes NY very favorable to trade when that happens, right? Especially once you see that sweep during NY and we see that offset, it's looking like a very probable trade that's going to go your way if, you've just reacted to a PD array and now New York Kill Zone starts, and of course we get a sweep and we start expanding away from that array, right? Now, the last session to touch on London Close Kill Zone, I've put a lot of emphasis on London Close Kill Zone for you guys. It's one of my personal favorite sessions to trade, right? Now, what's my criteria for trading London Close Kill Zone? The first obvious one is, again, going back to the ADR, this is why they pair together. Let's say London delivers 60 pips, expected ADR once again is 80. New York comes and just retraces or accumulates, right? And you don't get any expansion from New York. Or maybe New York adds, 5 pips to your actual expansion and then just starts retracing. Doesn't give you anything nice. Then we can anticipate London Close Kill Zone to, right, deliver the rest of the ADR. For this to happen, however, we need a sweep first. We need some sort of sweep during London Close Kill Zone or just before, and then we see an offset. The offset is the most important part. London Close Kill Zone, right, will deliver liquidity. That is what we're looking for it to do. And now, the same way, right, the next point I have is London Close Kill Zone can trade back into the range. So what's needed for London Close Kill Zone to go back into the range? If New York Kill Zone, right, delivers your ADR, let's say, you've completed your 80 pips, but you traded into an array and you have displacement away, what you can sometimes expect is London Close Kill Zone to, follow through with that displacement and now start trading back into the daily range that we created. And again, you want to target some sort of liquidity. With London Close Kill Zone, I'll suggest that you guys are conservative, take your profit. It is late. And another thing I'd definitely recommend, do not go into trades after 4 p.m. Look to enter before 4 p.m. and any opportunities after, it's fine. Just let it go. Remember, there's always another trading day, right? It's not necessary that you have to get a remove. If you miss it, it's fine. Paper trade it. That's still, a win in my eyes, at least. If you paper trade it, get the direction right, and you understood what you were doing in that moment, why you were taking that trade, right? So cool. That's London Close Kill Zone. So just a quick recap. Right, think of it very chronologically, guys. Of course, the sessions come as Asia, London, New York Kill Zone, then London Close Kill Zone. What happened in the previous session is what will qualify you trading the next session. Like I said, if Asia is a massive range, trends, if Asia, trends and is not a range, then we don't really look to trade London Open Kill Zone. If London Open Kill Zone over delivers and delivers a large portion of the daily range, then of course we reconsider trading NY. If, right, NY doesn't really give us any expansion, doesn't complete the ADR, let's say, then we can look to trade on a close close. And if it trades into an array, if you have some sort of framework, perhaps, a market maker buy model, sell model occurring, a very obvious PO3, you have a draw, then we can look to trade on a close kill zone. That's what we look for. And, vice versa. If New York Kill Zone didn't trade into an array and is complete the ADR, then we're not really bothered about trading on the close kill zone. It's very unlikely that it will offer you something if the ADR has been delivered and we didn't trade into an array for it to offset some sort of reaction. I hope that lesson was quite simple for you guys. It is just based on a lot of logic and understanding and reading the data that the charts are giving you, then using that to plan your next move. Of course, if there's any questions, just let me know and I'll be happy to help.